Hello, this is Mark from tradinginform.com and welcome to this video on the Santa Claus Rally and using technical indicators. What I'm going to look at in this video is firstly the historical basis of the Santa Claus Rally and its effect on stock markets, and then I'm going to have a look at whether or not we can use this Santa Claus effect with technical indicators to make more profitable or different types of trading strategies. Now I'm going to be using the S&P 500 as my proxy for stock markets, and I've got that chart on the screen at the moment. Now this video is being recorded in December of 2015, and this little candle here at the end shows that so far Santa Claus has not been very generous to equity traders. But it is still relatively early in the month, and the Santa Claus effect is traditionally seen as coming later in the month. So my analysis, I'm going to be using a spreadsheet. Now I've carried out the analysis in this particular spreadsheet, and this is a trade-informed backtest model. It is a great way actually of testing all sorts of trading strategies. You can test long and short trading strategies. You can import all sorts of historical data, all sorts of time frames, a wide variety of technical indicators and chart patterns can be programmed into the model. Now if you'd like more information about how you can use these backtest models, trade-informed backtest models to test your own strategies, there is a link on the screen for more information. Now the test that I'm doing today is, as I said, on the S&P 500. I've got quite a bit of data. I'm going here from 1984 all the way up to the most recently completed December, which was 2014. So I've got quite a few years worth of data there. Now if I just scroll down here to the 1st December that occurs in the data, we can see that we have a long signal generated here. And if I can go across here, we see that happens on the first trading day of December 1984. We have a closing signal which occurs here, which is the first trading day of January 1985, which gives us a full month's worth of data. If I go across, we can see that the profit and loss is recorded in this column here, and we're starting out with a notional $100,000 of capital, and so a profit here of $1,566 is around 1.6% of a gain over this particular month. Now the spreadsheet's added up and tallied all the gains, and we can see them shown here in the results table. Now the first thing that is worth noting is the capital graph shows a pretty good upward slope over this time period. If we look here at the results table, we can see the same sort of thing. 84% win percentage, 84% of Decembers were up months, which is the highest, although I'm not going to do it now. I have looked at all the other months and it is the highest percentage of months. Interestingly, over this time period, the total number of positive days, you can see the underlying market is 53.4%. So statistically, this win percentage of 84% is pretty good for December. Now, a few other things of note. We started out with $100,000 of capital. Net profit over this time period, $102,000, so that's pretty good, over doubling of the account. What's also interesting is the profit factor, which is gross winning trades divided by gross losing trades, shows that we have a very healthy ratio of winning trades to losing trades. Finally, we've got a very low drawdown for such a long time period, and over such a long time period to have a drawdown of just this amount, 12%, is pretty good. Right, now I said that I was going to include technical indicators, and I'm just going to go onto the chart to have a look at these indicators. Now the first one I'm going to use is the Stochastic Oscillator, very widely used. I'll add this to the chart here, just some standard settings, 1433. And I'm not trying to do anything clever here, I'm just trying to look at the basic indicator. For a real strategy, it might well be appropriate to use stop losses, profit targets, but I just want to see the effect of the indicator. So I'm going to use it going from an oversold area to an overbought area. And what that means is we need a crossover of this 20 line, crossover above the 20 line to open a trade, and then a crossover above the 80 line to close that trade. Now the other indicator I'm going to use is another very popular indicator, which is Bollinger Bands. And I'm going to use it slightly differently. The only difference I'm going to do is I'm going to narrow the width of the bands to just one standard deviation. The reason for this is because I want to generate more trades so we have a decent sample. Now again, I'm going to use it in the same way. A close, in this case I'm going to use a price close below the lower band to open a trade, and then a subsequent close above the upper band to close that trade. Now, I've already done this analysis. I did use this spreadsheet to do the analysis, and to be honest, it didn't take very long. I've got here the results that we've already seen, the buy and hold results here. Now we have the stochastic results, and I'm going to take out a few things that were interesting to me. Firstly, we've got a slightly higher win percentage, although as we can see, this comes with only half as many trades as with buy and hold. So an immediate issue that stands out to me is that if we want to use stochastic, we've got to get it to generate more trades. We have to be very patient to trade a strategy that only has 15 trades in 30 odd years of trading. But aside from that, a win percentage of 93% is pretty good by most standards. Now then, Bollinger Bands, as I said, I narrowed the bands to generate more trades. We just weren't getting enough trades otherwise, and I've got 18 trades. What's notable to me in this is a 100% win percentage. I'd be very happy with that personally. Also, we've got a high number of gross winning trades, almost as high, of net profit, almost as high as with the buy and hold. So again, very encouraging. Our drawdown as well is the lowest of the three at 9.3%, and our average profit per trade is the highest of the three. So again, very encouraging results. The one downside I would say to both of these, and even potentially all three of the strategies, is that they're not trading very frequently. So ideally, it would certainly be something that I would be looking at is maybe even to combine these, maybe even to look at other technical indicators to get as many high probability strategies as we can during what historically has been a good month for the stock markets. Now for more analysis, more technical analysis and historical price analysis, as well as the financial markets in general, please go to www.tradeinformed.com.